This is Steve Coker, president of Cedarstone Advisors, and this is the April edition of Cedarstone Economic Insights. Today I'd like to talk about the current stock market valuation. With stocks continuing to grind higher and as the bull market extends into the seventh year, there are increasing calls for a market top. Is there a stock market bubble? Well, it's our position that while the market is not cheap, current valuations are reasonable and far from the bubble talk that we are seeing in the media. Here is an example of what we're talking about. Here's an article from the Wall Street Journal from March 9th entitled "Stock Bulls Run on Shaky Ground." Is this a market top? Well, if we take a look at the chart of the S&P 500 for the last 3 years, it certainly looks like a bubble, particularly with 20% per year appreciation over the last 3 years. It's an understandable sentiment, but in our view, unlikely to be a bubble. And that's because the last 3 years have actually been a catch-up to the norm. Let me show you what I mean. It's important to remember that earnings drive stock prices. If you took just one slide from this presentation, this would be the one that best illustrates how the stock market works. Don't forget that when you invest in stocks, what you are really doing is buying a share of the earnings in the company. It really does come back to cash. Now this chart shows earnings of the S&P 500 in red compared with stock prices in black since 1988. When you take a step back and look at this longer period of time, it becomes clear that earnings do drive stock prices. Yes, in the short term, many things can move the market, but ultimately earnings are what drive valuations. This chart also illustrates that despite the terrific run-up in stocks over the past 5 years, valuations compared to underlying earnings are not yet crazily stretched, particularly when you compare to the second half of the decade of the 90s when irrational exuberance really did take over. 90s really were a stock market bubble. I think it's also worth pointing out that the 2015 earnings forecasts have already been revised lower for some of the other negative news that you're seeing in the media, such as strong dollar and the collapse in the energy sector. In our view, investors are looking through 2015 to the 2016 earning potential. 2015's earning estimates are $121. 2016's earning estimates are $137. Both are shown as red squares on this chart. Another way to look at valuation is by tracking the price-earnings ratio. You can think of this as the cost of a dollar of earnings. Historically, the PE ratio has averaged around 17.7 times trailing earnings. At 17.3 times estimated 2015 earnings, current PE ratio still looks reasonable by historic comparison. Now, the stock market's PE ratio is a function of inflation and earnings growth expectations, and it's important to remember that the market's PE ratio in the 70s and 80s, shown on this chart, was extraordinarily impacted by the 80s inflation spiral. It looks to me as though the market's PE ratio during benign inflation, as we have now, has centered around approximately 17 times. Lastly, let's take a look at the long-term trend in prices compared with the annual earnings growth of the S&P 500, 7.8%. If we graph the 7.8% earnings growth trajectory for the S&P 500, shown as the gray line, and compare to the actual earnings, shown as the red line, we can see that current earnings levels are also not in the bubble territory. Earnings growth over the last 5 years has been right in line with the long-term average, not creating unreasonable expectations going forward as happened in the last 2 stock market bubbles. Bottom line, given what we are really seeing in the stock market, valuations do not appear stretched in our view, and while not cheap, we do not believe the stock market is in a bubble. Hope this was helpful and appreciate you taking the time to listen to this talk. Thanks so much.